Right, so one of the simplest concepts and strategies you could trade with the banker is a simple hedging and averaging strategy. Now, the only real thing you need to grasp with the markets here is that they go up and down every millisecond. Markets are going up or down. There are retracements, there are ranging markets more often than they trend. That's an actual fact, okay? The key with a hedging and averaging strategy is finding ranges and making sure that you've set your risk management outside of that range. You'll have to take a loss from time to time. Yes, martingale, in my opinion, works best for a hedging and averaging strategy. And the reason being is the bigger the positions are that go against you, the less of a pullback you need in the market to close that sequence. I've not got a lot really to show on screen here because there's no real logic to an entry because it doesn't need it. Okay, so let's say we turned on and enter a buy and sell here. The sell will make profit and the buy will go into drawdown first here, enter some positions, and then the buy will close and the sell will go into drawdown, and then the sell will close here and then the buy will go into drawdown. So basically you'll have open positions most of the time and you're just trading how the market moves up and down. It literally is as simple as that. Watch it in this visual mode video. The only difference to that is if you're using delay and if you're using reverse. But if you're using delay, it will simulate positions before they open. That could either improve your specific entry or buy you into a particular uptrend. For example, if you had a delay of 4 and you would reverse the sequence, basically there'd have been 4 buy trades open, all that would have banked, which meant that there's an uptrend. So then you can just get it just to buy into that uptrend. So there's no specific mechanics ultimately around that, like RSI or EMAs or whatever for the trigger of the trade. But ultimately, it can be as simple as that. Markets move up or down. That's why retracement levels are popular trading strategies, right? 50% fib, 61.8 fib. So markets do reverse, markets pull back. There's never been a market that just goes 100% up without any selling pressure or price coming up and down. So hedging and averaging can work a treat. Watch the video with martingale with risk management, because martingale can get out of hand. Your trading should never rely on hope. Always know where you're out of the market. And there'll be times where that trend is just bigger than the range that you'd normally set and planned for within your test. So you just got to accept that, right? That's just trading. Same with any strategy. You are going to take losses from time to time. So have a watch of the video and hopefully that helps.